Are you tired of losing sleep over stock market risks? What if I told you there are proven ways to minimize your risks while still growing your investments? In this video, I'll share 7 powerful strategies that professional investors use to protect their portfolios. Stick around, this knowledge could transform your financial journey. Hello, and welcome to SmartCoin Chronicles. Investing in the stock market can feel like walking a tightrope, exciting but nerve-wracking. However, smart investors know that success isn't just about making big gains. It's also about managing risks. In this video, I'm going to share 7 proven strategies to reduce your risks in the stock market. These techniques are simple to understand, easy to apply, and used by some of the most successful investors in the world. So, whether you're new to investing or have been doing it for years, this video is packed with practical tips to keep your portfolio safe while still aiming for growth. Let's dive in. Let's start with the golden rule of investing: diversification. This simply means not putting all your eggs in one basket. Why it's effective? By investing in a variety of stocks, sectors, and even asset types, you spread the risk. If one sector underperforms, others might still do well. Pro tip: include a mix of large cap, mid cap, and small cap stocks in your portfolio. Consider adding bonds, ETFs, or mutual funds for further diversification. Diversification reduces your exposure to the poor performance of any single investment and stabilizes your portfolio over time. The second way to reduce risk is to know your risk tolerance. Everyone has a different capacity for dealing with financial ups and downs. How to determine yours? Ask yourself, how much am I willing to lose without panicking? Younger investors may be able to take on more risk, while older investors might prefer stability. Actionable tip: use online risk tolerance quizzes to get a clearer idea and align your investments accordingly. Next, focus on investing in high-quality companies with strong fundamentals. These are businesses with steady revenue, manageable debt, and a track record of growth. Why it's smart? Quality companies are more likely to withstand market downturns and recover faster. Pro tip: check metrics like the company's PE ratio, profit margins, and annual revenue growth before investing. Tools like Yahoo Finance or Morningstar can help. One of the most underrated tools for managing risk is the stop-loss order. This is an instruction to sell a stock if it drops to a certain price. Why it works? It prevents you from losing more than you're comfortable with, while allowing the stock to recover if it rebounds. Example: if you buy a stock at $100, set a stop loss at $90 to limit your losses to 10%. Staying informed is crucial. Stock markets are influenced by news, global events, and economic trends. Why it reduces risk? When you understand what's happening, you're less likely to make impulsive decisions. Avoid panic selling or FOMO, fear of missing out. Actionable tip: follow credible financial news sources and use tools like Google Alerts for updates on your investments. Another strategy is dollar cost averaging, where you invest a fixed amount of money at regular intervals, regardless of market conditions. Why it works? This strategy minimizes the impact of market volatility. When prices are high, you buy fewer shares. When prices are low, you buy more. Pro tip: automate this process through your brokerage account to stay consistent. Finally, adopt a long-term mindset. The stock market is unpredictable in the short term, but history shows that it tends to grow over time. Why it's effective? By focusing on long-term goals, you avoid the stress of daily market fluctuations and allow compounding to work its magic. Pro tip: review your portfolio quarterly or semi-annually instead of checking it daily to avoid unnecessary worrying. To recap, here are the 7 ways to reduce risk in the stock market. Diversify your portfolio. Understand your risk tolerance. Invest in quality companies. Use stop-loss orders. Stay informed and avoid emotional decisions. Practice dollar cost averaging. Keep a long-term perspective. Remember, risk is an inherent part of investing, but with the right strategies, you can manage it effectively. If you found these tips helpful, please like this video, Subscribe to SmartCoin Chronicles and hit the notification bell so you never miss our updates. Let me know in the comments which strategy you're going to implement first. Let's grow your wealth together.